Welcome to episode 28 of the Cashflow Connections podcast. Our topic for today is how to create wheelbarrow profits through multi-million-dollar refinances. One of the many benefits of investing in real estate is the ability to add value and refinance in order to return a significant portion of your originally invested capital. In fact, sometimes you can even refinance more than you originally invested, and it allows you to grow your portfolio quite substantially. And, some people would consider that to be an infinite return because you actually don't have any money invested at that point and you're still able to continue to invest. The key to this strategy, though, is that when you refinance a property, you're not necessarily paying taxes on that transaction because you're not accepting a gain. You're just borrowing more money with that same property as collateral. Many real estate moguls out there attribute a substantial portion of their growth trajectory because this one strategy is so favorable, and the tax implications are obviously quite favorable as well. So in this episode, we're going to talk about how our guests have received more than $3 million in refinancing proceeds without raising a single dollar from investors. How to establish credibility so that when you go to a lender and you're trying to convince them that you're the type of person that is worthy of taking on additional debt, how you can really facilitate that and how you can build an infrastructure that will facilitate that. We also have an interesting conversation about maintaining underwriting standards while prices are inflated. And our guests are really entertaining, and so the conversation is really quite interesting. Now, before we get to the episode, I wanted to notify the listeners that our referral program is now fully integrated with the website. Originally, this was going to be a short-term thing, but the program has resulted in a significant amount of new contacts coming to the Cashflow Connections site. So if you have an account with us, when you log in, you will see a tab that says Share CFC. All you have to do is click the tab, you get access to your personal referral link, copy that link, send it out to your friends, and for every accredited investor that uses it and completes an introductory call, you will get a $200 Amazon gift card, and that is emailed directly to you, so it's really hands-off. You don't need to do much. Probably the easiest way to make $200. And we've already sent out several of these, so we're happy to grow our business by allowing you to share CFC with your friends. So make sure, go ahead and log in, get access to your link, and we'll shoot you that $200 Amazon gift card, which surprisingly goes a long way these days. I mean, I just recently got an external monitor for less than $200. Especially when it comes to technology, that can go a long way. All right, I hope you enjoyed the episode. How's it going, everyone? Our guests for today are Jake and Gino, who are real estate entrepreneurs who specialize in the affordable multifamily sector. Together, they control over 700 apartment units. They also co-authored a book, which is titled Wheelbarrow Profits, and it teaches investors the three pillars of investing in multifamily apartments: buy right, manage right, and finance right. Jake and Gino also operate jakeandgino.com, which is a real estate educational company that offers coaching and training in real estate investing. They are an entertaining and unique duo. So Jake and Gino, thank you very much for coming on. First ever Cashflow Connections podcast with two interviewees. So thanks again for joining us today.
Hey, happy to be the first ones.
Thanks, Hunter.
Absolutely. So obviously we want to talk about some refinances that you guys had and maybe potentially get into some deals you guys are looking at. But before we jump into those details, let's get a big picture going. When did you guys really start working together, and how did you get interested in this space originally?
Well, yeah. Hunter, this is Gino for all the listeners. This is, I guess, age before beauty. I'm the older one.
Oh, come on, man.
we just a quick backdrop. We got together about 6 years ago. Took us about 2 years to find a big deal. And we actually got our first deal in February of 2013. And for the listeners out there, it's that really first deal that will propel you into the business. You really want to take that first step. Without that first step, you will never start anything. It's just like, should I, could I, would I? You have to jump in and you have to get that first deal done. Once you get that first deal done, I mean, that fear will never leave, right, Jake? I mean, we always have those butterflies in our stomach. We're doing a deal right now. There's so many ifs. You have lawyers telling you, the doomsday scenario. Then you have Jake flying by the seat of his pants going, dude, we got this. So there's a happy medium going.
Get him out of the way. Let me go.
There's a happy medium going in it. But, as to what your question was, I completely forgot what your question was.
He was saying kind of how and when we got started. So we got started, we tried to buy deals back in 2013. It was sort of as everyone was, starting to come out of, everything that collapsed. And we were having a hard time because we didn't have any credibility. I had just moved to Knoxville from New York. Gino was still in New York. And we were trying to get into some apartment deals. I had some, doctors at the time. I was a vaccine rep at the time, mentoring me, saying, look, the way you're going to build wealth is through real estate. And I like multifamily because people are always going to need a place to live. So, it took us 2 years. We kind of quit, came back to it, quit. And I think the best thing we ever did was we hung in there. We didn't quit completely. And we finally got a deal in 2013. It was a small mom and pop deal. Sometimes I call it the crack den. You got to start somewhere though. And we knocked out that 25 units. And now I guess 2017, we're closing on another 110 units in December 11th. And it's going to put us over, 50 million in multifamily real estate. So it can move really quickly once you get that first one done. And I think that's what Gino was alluding to. You have to take action. You got to jump in and get that first one done. And then you can start knocking them out left and right.
Awesome. And within the multifamily space, what is your niche? What's your kind of bread and butter opportunity?
Well, we started out just by default. We just fell into, we call them mom and pops. I mean, they're basically, in any endeavor in life, you're always trying to find somebody who's motivated to do something. I mean, and that's where you get a deal in life. And that if you're trying to buy a lakefront home with no problems, you're not getting, you're buying retail, you're not buying wholesale. You need to be able to find something that you can either add value or you're trying to solve a problem. And, mom and pop, I don't know if we coined the term, but every single one of our deals has been a mom and pop where we actually found the problem. There was motivated seller, and motivation comes in so many various forms. I mean, we've written this in our book. You can have somebody who's getting divorced. You can somebody who's losing a job, somebody who's burned out, somebody who has no systems in place, somebody who has partner acrimony. You have brothers and sisters and family members who are fighting. It comes in so many shapes and sizes. And, when you're negotiating, you really have to listen to why they're selling. Ask those questions. I've written tons of articles on this. Ask why they're selling. You have to figure out how you can add value to the deal. And our first deal was very simple. Two owners had this property on LoopNet. It was listed at a very high price. It was sitting there for a couple of years. They finally, I wouldn't say they reached their breaking point, but they were ready to sell. And we took advantage of that by coming in. We probably paid a little too much. It was our first deal, but hey, it is what it is. Our finance rates were not the greatest. As Jake likes to say, they practically stunk. But hey, you have to start somewhere, right? And we just put an offer in. We got seller financing on our first deal, which was actually pretty impressive. I knew a little bit about it, but I never really pulled one off. And we did that on our first deal. But they were motivated. They wanted to retire. They wanted to get out of the business. And like I said, it was a mom and pop that had no systems. They had no website. They were not doing any application checks. They weren't doing any background checks. They were just, basically renting to anybody with a heartbeat. So all those things we saw as opportunities.
Yeah, and to piggyback off that a little bit, two of our deals, I think two of our bigger deals. One was almost a 300 unit complex, and we bought that from a family that inherited the property. So the brothers and sisters, and there was infighting, and the one brother didn't want the other brothers to get it because they were going to take it away from his wife, and Susie was going to punch Sally, and it was just it was a mess. We were able to solve a problem. We got in, we got him out of the deal. It was $11 million deal, $11 million deal, and we actually put no money down on it. We got 20% seller financing on that deal. It wasn't our first deal, so we had credibility, and we were able to negotiate with the banks to get them to finance it. But after you're in the game for a while, you can pull things off like that.
And Hunter, what I'd like to tell the listeners also is I think as investors, you have to be able to sell yourself, and you have to be able to paint the picture of what you're trying to do, whether it's to an investor, whether it's to a broker, a banker, or a partner. And with that deal that Jake was referencing, was 281 units. He had it listed at $12.6 million. So we started painting the picture very simply by sending over our underwriting to him and telling him that it just didn't work at $12.6 million. We made him see the colors on the underwriting, red, red, red. Nothing worked. He came back with us. First offered us $11 million. 80% bank financing. He'd hold a note for the remaining 20%. Now, people are saying, can't do that. On our first or second deal, probably not. By the time we had this, we had our credibility book. We had our vision of what we wanted to do. We had our great relationships. And also, what was the risk to the bank? If we stopped paying the second, he would just take over the property and take it and reassume it. That's what one of the smart bankers actually saw. There's no risk to that.
His audience might know this smart banker because I think he has some mobile home folks out there. Jim Clayton, the founder of Clayton Homes.
Absolutely.
He financed that deal. His bank actually financed it. And when people were starting to get a little funny about it, Jim actually stepped in and said, guys, if these guys crap out, the second is the current owners, so it just defaults back to them. So it's good when you get a good network and good bankers around you like that, like Jim, who had the ability to think bigger and understand a complex situation, and it enabled us to get the deal done.
And to finish that off, we actually sold ourselves. We sold what we were going to do. We told them that, hey, 10 of these units are being rented by family members. Half the portfolio really is under rented. Where can we add value to this property? We took it over. It was doing $140,000 in revenue. The first month we took over. The following month, we bumped it up to $170,000. That's no joke right there. 30 grand 1 month. And right now, what's a trailer?
No, a good month now is 200 for us.
I mean, so you're going from 140,000 in revenue per month up to 200. And on top of that, expenses did not explode because we actually reined in expenses. They were running it inefficiently. And that's what we look for in those mom and pops. We look for those inefficiencies. They had a terrible, awful website. It was out to college students, and they were renting it inefficiently. They weren't doing things properly. So we just took over the systems. It was a little bit of a learning curve for us, and it was a huge property. We had to employ a couple more people in the property. And it was a great learning experience for us.
Wow.
We love doctor owners too. We look for doctors. Doctors are great people to buy from as well.
Yeah. That's something you find in some of those industries where you have to be actually super skilled, right? Because they focus on the skill. So like attorneys, CPAs, doctors, etc. They tend to make for great sellers. No offense to the attorneys listening out there in particular.
I don't know. It's okay.
You mentioned offline that you were able to refinance 3 properties recently and return a significant portion of investor capital. Could you tell us a little bit about those deals in particular, or that whole process?
Sure. What happened was we bought our first big deal back in February of 2014. It was actually the day before Valentine's Day. And I knew it was going to be a transformational deal for us. It was 136 units. At the time, things were trading, in the $29,000 to $30,000 per unit range. Now it's prices have exploded because rents have exploded. And also, there's a lot more demand. But we had bought the property at $4.075 million. We held the property for about 18 months. And after 18 months, we went to refi it to a community bank. We got a valuation of
6.3, right?
$6.3 million. Yeah. We were able to refinance $1.6 million out of that deal.
This is going back to 2014, 200. So he's just telling the whole story.
Yeah, so. I'm giving you the whole story because I'm saying we started out with community banks. It was a recourse loan. When you first start out, you have to do what you got to do. So we tried to go to CMBS. We tried to get Fannie debt on it. Agency debt on it the first time. They just did not want to do it. So we were thrilled. We put $800,000 down on this property. We put 15% down. It's great. And we got back $1.6 million. We continue to run the property efficiently the way we've done with all our other properties. And to start out with, the rent on the property when we first started, the gross income was $53,000 per month when we took over. When we refinanced the property, it had jumped in 18 months. We had a little seasoning on the property to over $80,000 per month. So you can see the vast, they were renting for $450 a month. We had gotten them up to $595 and $600, $625 per month. Plus we instituted RUBS, a bill back system. Plus we got laundry on there. We started, doing application fees, pet fees. We started doing, late fees, and all, it really builds up. Those ancillary fees can be 5 or 6% of income. So if you're doing $80,000 a month, you're talking about another $4,000 a month, and those fees that just appear magically. And you talk about RUBS on this property at 136 units when you're charging $30, just even 30, a minimal $30 per month fee. That's another $4,000 a month on top of that. So you're talking about huge, value adds that you really need to look for. So we did that 18 months after. So from that point on till today, in August, we were approached. We, set up with a gentleman who were doing Freddie financing, and we were able to refinance the property again because now the income is at or around $100,000 per month right now. We were able to get fantastic terms. We got non-recourse financing on it. We got 30-year amortizations. We got 10 years of a term. We got 3 years of interest only on this property, and we were able to actually pull out another $2 million plus on the property on top of 1.6 million. The valuation, is incredible. But so people are wondering, oh, wow, you're really leveraging yourself up. Not really, because we're still basically an 80% LTV. Our payment has actually dropped because of the 3 years of interest only, because we've gotten a longer amortization. So our payment has actually dropped from what we're paying because it's interest only. So within the 3 years, we're anticipating that the payment's going to be what it is, with principal being on, because we think that, rent's going up 2% for the next 3 years. And on top of all the other fees that we're going to be able to accumulate, we're going to be at that same price. So we're going to be okay with it.
Plus Freddie looked at the deal really hard, underwrote it, it was the kind of agency debt process. And I just want to, say, so we'll be IO for 3 years. It can carry it now. Fine. We're still going to make money on it. But also 3 years from now, once the IO burns off, we hope to minimum raise 2% a year, even though we've been crushing that. Even if we can raise rents 2% a year, we're going to be, back in the same spot we were before we refied. And one thing that you mentioned earlier, you said, hey, talk about those returns to investors. Well, the cool thing about us is that this is all our own money. It's me, Gino, and we have another partner. So when we're talking returns to investors, we're returning it all to the house, which is great.
Yeah, so that is really significant. That's awesome to hear. And I think that you said about $30,000 a door on purchase. What market is that located in?
It was in Knoxville. So basically, it was a C property. These guys were running it very inefficiently. They had a 4,500, a person manufacturing plant down the street, and they're trying to get 650, almost 700 credit scores for these renters. It was really bad. They were using 5 units of storage sheds. It was sitting on the market for 5 years on LoopNet, so you can find deals. It was listed at 6.3 million. And for your listeners, there's no such thing as a lowball offer. I offered 3.7 million. I thought I was going to get laughed out of the building. They actually came back to 4.4 million. So that's when I really started learning about negotiation. I knew their pain point. I knew they wanted to sell, and I gave them a fair offer based on underwriting. The market has changed a little bit, but still, if you're going to try to underwrite a deal and get it financed by the bank, you still have to have, conservative underwriting. You still have to come in with those. And I came in with that. And, it was really funny that one shot, they went down $2 million. To get them down $300,000, it took an extra 6 weeks. So it was a process. It's funny how it is, because then egos start coming in.
That's a nice return.
It was a great return. And the other thing with that was just be creative. We actually, for the remaining $50,000, we actually had the broker hold a note for his commission. So when we refied that property, we paid the broker off his $50,000 note. And
that must have taken some negotiation for sure.
But you know what it is? The broker really was going to made a nice little clip on this. Plus, he knew we were going to refi the deal. Plus, when he's got $500 a month coming in, it's a great thing. He deferred his capital gains to the following year, so he didn't take all that hit in 1 year. And he knew he was going to do. And he actually did the next deal. That's the 281 units. So he knew he was part of our team. And for us, it was a stretch, because, like I said, it was our third deal, and it was a lot of money for us to come up with. We didn't want to dilute ourselves. We wanted to get as much as possible. And we were, Hunter, it's all about your makeup. I was a little bit uncomfortable at the time asking people for money. I didn't have the mindset of saying, hey, well, I'm offering somebody an opportunity to make 8 to 10%, or maybe to make triple on their money. I wasn't comfortable with that yet. And I wasn't comfortable with my business model. I didn't know we were doing mom and pops at the time. I didn't know they were adding value and able to do all this stuff. So that's why, for me, I wasn't comfortable raising money in the very beginning. For other people, maybe they're more comfortable with that. Maybe that's what their skill set is. But, in the beginning, Jake and I were just trying to get our minds wrapped around multifamily and trying to run it as efficiently as possible.
Totally. You want to establish a track record before bringing. Yeah, I completely relate to that. I was very, very slow to scale and bring on investors for the exact same reason. You want to be able to verify your track record, not only to investors, but to yourself. And when you can do both, they can pick up on that if you know what you're doing and you're confident, and not overconfident, but conservative in that approach. Give us an idea of the cap rates of those markets back then, maybe, and now. I'm very interested to hear what you guys are seeing in the marketplace, like a place like Knoxville, Tennessee, which I know has experienced a lot of growth. Both that market and Nashville, for example, are just very hot right now. What are your thoughts on that?
We have a lot of thoughts on that. So, we in our book, Wheelbarrow Profits, we talk about buy right, and we set up parameters in that book in terms of what we're looking for in terms of cash on cash, what we're looking for in terms of cap rates. And we've actually, we have about 700 units right now. We're picking up another 100 in December. We haven't bought anything since March of last year. This is going to be the first deal we've done in over a year. And the reason being is because, look, we were knocking out 8 caps left and right up until March of 2016. Then all of a sudden, the switch just flipped. The game totally changed in our market, and everything just went through the roof. And we have a comfort level in that 8 cap range, and we were like, we're not overpaying for this stuff. We have lost deal after deal after deal after deal. But what we're starting to see is even some of these deals that we bought at levels, we're saying, well, if these would have shifted down to a 7 cap, would you have still done it? And the answer is yes. So, we're looking at a deal right now. The deal we're doing in December, it's probably a 7 cap, probably 6.8 cap, but we know it's really grossly under rented, and there's a lot of upside. It's not going to be as good as the deal we did in, say, March of last year, which was a true 8 cap. It was 156 units. But it's still, there's enough meat on the bone there where we're going to do really well with it. So it kills me to say it, but we've had to shift down a little bit, and that's just the market. And you got to kind of take what the market gives you, as my friend here likes to say.
I was just about to say that we're actually we're finishing our own sentences, which is a little scary, right?
Oh man, romance is killing them, huh?
But it is. But my problem was that it's almost like anything else. When you used to pay, let's say $30,000 for a car, all of a sudden, that was a good deal, right? All of a sudden, the price goes up to 42. You're still getting a good car. You're still getting a great deal, but you're used to paying 30. It's hard to get over that hump. And I blame myself for that a little bit, I think, and being a little bit conservative. But I just couldn't get over it. And I actually had one of the guys we were podcasting, one of our guests, made me understand that. He says, hey, you can't go in the past. That happened already. You have to, actually ratchet yourself up and see what's going on. And as far as taking what the market gives you, I guess on the flip end of it, we've got these fantastic valuations from these banks, and that's why we were able to refinance. So always look at what the market's giving you. And if Natural's is probably at a 5 cap right now for the assets we're looking for, the B plus, B minus C area. I mean, there's certain markets that are so much more attractive than where you are. So if the market's not giving you what you want, either get out of the market, either go into a different niche, whether you want to fix and flip, vacation rentals, go into a different or just actually go into a different market altogether, go into a different city and start looking elsewhere.
When you guys buy properties, it sounded like the real value add was generated by just simply increasing rents. Are you going in and renovating properties as well?
To a certain extent. I mean, like the deal we did in March, we had at a dog park. We put on this big 58-foot sun deck. But this is all in-house. We got a small construction team, and we're not subbing this stuff out.
Okay.
We like to do two-tone. Some of these apartments would take over. It's all white. Everything's just white, right? So we'll do a two-tone paint scheme. We'll do a nice light gray. If the outlets and things like that are that almond color, I think they call it, we'll do white. Sometimes we'll refinish countertops, $150. Maybe paint the cabinets. Maybe we'll do a gooseneck faucet, right? And we like the wood look vinyl. But a lot of this is done on turns. So, our model is essentially we go in, we fill the vacant units at market rent. That's step one. We hope there's a RUBS play. Next, we're going to implement RUBS to the entire community. Once everyone's out of a lease, et cetera, it might take a year. Following that, we're just going to start, one of the big things is, maintaining that yearly growth. So every December, we're not using a software or anything. We're evaluating, and we're raising rents every year. So it's filling, raising the remaining renters to market rate. So, we'll see what the market's giving us, what we can get out of it. And then we're taking it from there. So, a dog park here or there, maybe a little sprucing up of the pool fence and things like that. But we're not going in, tearing out cabinets because we have a fund behind us that says you got to spend a certain amount of money. We're doing things as efficiently as possible, and where we see the ROI, that's kind of what we're attacking.
And Hunter, that a few years ago, I guess that was the model. But I just think right now, with the assets coming online, with all the A properties and all that, it's a little bit riskier now, because if you're trying to get a B property or a B minus or C property and trying to reposition it upwards, you've got a lot of inventory right now that's coming online right now that is already in that space, and you're competing with that. Would you want to have a 1980s build that with a beautiful kitchen or whatever all redone? Or do you want to go into an A property that was built last year with a sauna, a tanning bed, a coffee shop, and all that? I don't know if I want to compete with that. So that model is a little bit risky right now, and everyone is doing it. And it just annoys me that you have to spend $10,000 per door to get $100 rent bump, and that just really, really bothers me. To me, there's no value.
I'd rather stop at Sherwin-Williams and get a can of paint.
Yep. No, that's
it's not.
totally
I don't want to oversimplify it, but seriously, I mean, a two-tone paint scheme and replacing the flooring when you need it. and making sure it's safe, clean, and affordable. I really do. I don't even want to say this. It's pretty common sense, I think, but I think the folks that win in the C plus B minus space long term are the ones that are able to offer good customer service, because these are the tenants that are usually neglected and get poor customer service, and their pricing is competitive. Meaning that if you're buying at a good enough price where you can compete on price, you're moving it as high as you can, but you're able to compete on price and you're offering good customer service. I think that is the playbook, at least for us going forward.
Makes total sense. Let's talk just briefly about this refinance process. Walk us through this process in terms of, you guys bought this property with the seller financing and that 80/20 loan.
Sure.
And then how much did NOI increase before you started to request a new refinance from another institution that first time you did it?
Okay, so we've done it like 6 or 7 times. The one we were talking about earlier, the 281 unit property.
Right.
So that was actually 2 properties. It was a 149 units and 132 units. So we first refied the 132 units. And Gino, correct me if I'm wrong, I think we pulled out like $1.8 million or something like that. Was it $1.8 million?
Mhm.
Okay. And we used that to actually pay off the note that we had or a good portion of the note that we had to the seller. Okay?
Right. The second.
Yeah.
The second, correct. And then we did the other one just this February, the 149 units. And it was funny because we used the proceeds to pay for the other one. So, and then we did that one in February of this year. We bought in, I think it was August 2015, right? And then so it was the final one that we did was February of 17, refied, and then, paid that other note off. So that one we were able to, it'd be nice to have, be able to take the proceeds to ourselves, but we didn't put anything into the deal. So we were able to clear up the seconds on that one.
So basically, if you think about it, I guess philosophically, the guy gave us the keys to a business for nothing.
Yeah.
We basically got that business for nothing. When we closed on the deal back in August 2015, the closing agent she was bewildered. She was baffled. She's like, "You're not putting any money on this deal. How are you getting money back?"
Well, because let me talk about this for a second. Because the initial closing, what we do is the prorated rents we always get back in the form of a check at closing to fund our operating accounts. And so we got back. I don't know how much was it on that. It was a good sized number.
Mhm.
Maybe 100,000.
It was about $100,000.
Yeah.
And the other thing is we didn't get cable money. We should have gotten a few bucks for cable money, but you get security deposits. And also if you have any repairs, we don't get repairs credited to the price. We just had this conversation with our lawyer this morning. I mean, the vernacular he was talking about, he calls it POC. Paid outside of closing, basically, or repair credit. You want it to fund your account. I don't want the price to go down because I can't use that money to fix the repairs. So we got a paid outside of closing repair. So we got all that money to fund our account, and it's a great way. It's a great way to start the property. Great way to start the.
But yeah, so to Gino's point, the closing agent at the title company was like, "So you didn't pay anything for this, and you're walking out with $100,000." She's like, "How the hell does that work?" And we're like, "Hey, I don't know. Just
That's what I always think about it with money and with this refinance. I think money is such a fallacy, and everyone has such a weird way of looking at money. Money, as I've learned to really learn. When I used to work, used to own the restaurant, and I used to work so hard at the restaurant, and I was working for money. And now, when you refinance a property, you're creating money out of thin air. It just almost bewilders me and baffles me how that even works. And it's hard for me to explain it to my wife because she's always asking me, where did money come from? I'm like, I really don't know. You know what I'm saying? All I know is that in this economy that we have, every day through the world currency markets, there's $3 trillion of money flowing through the economy every day through the world currency markets. That is $1 million you spend per day for 8,000 years. Just wrap your mind around that. So when people tell you that we have money problems or there's a scarcity of money, that is the complete and total opposite of what really is happening in the world right now.
That's a really good point. And I read a book recently by Grant Cardone, The 10X Rule, which is a pretty mind-blowing and powerful book. But in that, there's so many one-liners, and one of them is when you wake up, realize that you cannot make money. You got to go get someone else's. So that's the idea. And there's a lot of it out there. He's like, you're not the Federal Reserve. You can't make money. You got to tell someone else to give me their money. So every morning I wake up and say, who's got my money?
Well, here's the next piece to that. We were both in, Gino owned the restaurant, but he had a cap on that, and I was a vaccine rep for a pharmaceutical company. At the end of the day, I had a ceiling. I couldn't make any more money. The minute I got out of that, and for all you guys listening, if you're in a W-2, I got out, 2 years? Was it 2 years after I started investing?
Yeah, 18 months, almost
18 months. As soon when I got out of that W-2 job, I started making more money and more money and more money and more money. And you guys got to at some point create your own wealth. The job is not going to do it for you. The stock market is not going to, 401k is not going to do it for you. You got to go get it. You got to take it. It's there for you to do. You can't just sit on the sidelines and work a job.
And Hunter, I think the important thing, for all entrepreneurs and everyone who wants to become wealthy out there is, I read a book recently, Millionaire Fastlane. The gentleman was talking. I love MJ DeMarco. He really hits you in the stomach a lot. But what he says is that his law of affection basically says to make millions, you have to affect millions. And that's what multifamily does for us. We've got tons of tenants. We don't have 20 or 30 tenants. We've got hundreds and hundreds of tenants. The more people you can serve, the more money you can make. At my restaurant, X amount of people walked in, that's who I could serve. I couldn't scale up unless I bought another location, then another location. But with multifamily, you start adding it on, and then you have other revenue generators on multifamily. You can start adding other types of revenue. But that's what I think we like about multifamily more than anything else.
And you can't buy it on Amazon yet.
Not yet.
Yeah. Good point. And you know what? I just want to add one thing to that before we get back to this, the conversation at hand, which is that while we're on the topic, of entrepreneurship and money in general, in real estate, when you go to buy a property and you look at a value add strategy, one of the key metrics is to find out what the market rate is, because you want to know how much value you can add to the property. You don't want to over add value because you can't have rents substantiate that. So your return, the amount of money you can make on this investment, is based on the market. But that is not the case with general business. It isn't that there's only so much you can make. It's unlimited. It's just a matter of how much you put into it and how effectively you execute. So there's no, this guy makes a certain amount of money, so that's the amount that I can make. No, it's unlimited as long as you execute effectively and put systems in place to optimize your time. So just wanted to add that there. So let's talk briefly about this strategy, because this is something that, to be honest with you, I have not utilized enough in my career, which is refinancing into perpetuity and holding indefinitely. Tell us a little bit about why you guys like this refinance strategy and some of the benefits of it.
Well, number one, it's hard enough to find a deal, right? Everyone's struggling to find a deal right now, and we're not raising money from people, so we don't have to pay back investors. This is our own money. So, a few things here. We're getting in. We're able to refi these things. Okay, we defer the tax, right? We're refining them tax-free. We don't want to sell because they pay us every month, right? And once you negotiate a deal, the second hardest part, unless you're going to Fannie or Freddie, is negotiating the terms with a community bank. So you go through all that headache, and then if you're just going to sell something to get taxed on it, a few months later so you can pay back your investors, I don't love that personally, because if I'm already making money on it every month, the thing's growing in value, the tenants are paying down the mortgage for me, why not just hold it in perpetuity? I don't see a reason why to sell. If I was raising money and the only way I was going to get paid is because I was a syndicator and I was getting clipped on the back end for it, I was getting ripped. That makes sense to me. We're putting our own money into these things. We want them to continue growing in value. We want the tenants to continue paying down the mortgage. We want to continue making money on them. And then maybe someday, if I turn them over to my kids, they can deal with the tax thing. But look, I think it's getting phased out by 2024, hopefully. So maybe they won't even have to worry about it, right? So I'm talking about the estate tax. So
Hunter, right. I think the other thing that I've learned over the last couple of years is I don't want to be a deal junkie. I think a lot of guys out there are deal junkies, and there's nothing wrong with that. But listen to this: transactions don't make you wealthy. Equity makes you wealthy. Brokers are broker because they're always getting these transactions. Guys who fix and flip are getting taxed at a higher rate. They're not keeping a lot of their income. They're paying it off, and they're going for the next job. And that's part of the problem that I had. That's why I got into real estate. I already had a job at the restaurant. I didn't want another job. I wanted to create that wealth. And that's the thing. I think syndication, if you really break syndication down, I've thought about this for a while. It's a sexy way of saying you're fixing and flipping, because that's basically what you're doing. You're holding the asset for 3 to 4 years and then you're flipping it out. And I mean, there's nothing wrong with that as long as you know that's your exit strategy, and as long as you know that's what you want to accomplish and you need that seed money for another deal. There's absolutely nothing wrong with that. But I think if you continue to do that, there's a little bit of a fallacy in that, because you're going to look back and go, wow, I had the cash flow ability, I had principal pay down. Tenants were paying my debt. I had the ability to shelter some of that with cost segregation, my taxes. There's so many benefits to doing it. And now the other problem is, syndicators are underwriting deals 7 to 10 years now because they can't sell because they're already buying at these compressed cap rates. They're adding a little bit of value on there. And then all of a sudden, what happens? They can't sell this thing. So they're sort of stuck with it.
And that's the other part I want to bring up. If you're doing cost seg studies on these things, right? If you buy enough, you can push your taxes out indefinitely. And as long as you keep buying and you can keep buying good deals, the party doesn't stop. You keep buying, right. you keep stacking up that depreciation, and you're putting yourself in a pretty powerful spot there.
Yeah, I definitely agree with that. And I think that, this is a strategy that is becoming more and more likely as we build properties, particularly properties that are in more prime markets. I think that strategy is even more valid. One of the challenges, though, when you're syndicating is it's difficult to raise. Okay, I'll put it this way. When people go to look at a syndicated opportunity, they want to know when they're going to get their money back. It's not about when they're going to sell the property. Mm-hmm. However, it's hard to advertise an infinite hold. But the key is, if I could get you both a return of capital and the property, wouldn't that sound better? And
that's your cake and eating it too.
Yep. Exactly. So yeah, and just for the listeners that haven't kind of pursued this or looked into this, the reason that you're able to get this money back tax-free is that you're not actually getting a gain. You're just borrowing more money. And so it's one of the ways that debt can make you more wealthy is because you're taking someone else's money at interest, which is also a write-off, and so it can be very tax advantaged. We know syndicators that have built incredible portfolios, and it's really the only way to be truly diversified is by holding on to assets for the long term.
And the other thing is, you have to really think of it in a couple of ways. We have no skin left in the game in any of these deals. So, I don't know if we have risk. First of all, they're going on non-recourse debt. Second thing is, all of our capital has been removed. Third thing, that's the velocity of money. That's what banks drool over. They're borrowing your money at 1. They're lending it out at 4. So they're making 3 points. They're not making 3%. They're making 300%. That's why they don't want to be in the business of owning real estate. They've got a fantastic thing. So Jake and I are just trying to really velocitize money, and that's what banks do, and that's what you want to do. We're not going to a party. We're not buying fancy toys. We're getting this money, and we're putting it into another deal. So that's what you want to constantly keep doing. Keep repurposing that money. Then all of a sudden, you're making $3,000 a month, then $4,000, then $10,000, then $20,000. Then all of a sudden, you're doing very well with these assets, and you just keep putting that money in, and it keeps growing. And as you can see, it's all about buying right. It's not what you buy, it's what you pay. And if you can buy these assets correctly and run them properly, they'll pay you, they'll pay you in perpetuity for as long as you own them.
Is there anything in particular that these banks are looking for that can expedite this process when you're going through trying to refinance a property?
Which community or agency?
Well, either one. Whichever you guys have had the most success with, I'd be interested to hear what you guys have been able to take away from that process as you've gone through it.
Get them. So if you're on the agency side, and you're dealing with a broker, the one thing that we've been able to do really well is build good relationships, and that's when they ask for something, we get it to them. And I think being professional is key. We use AppFolio. I think they're the third largest or something for multifamily property management software. If I need an income statement, it's like 3 clicks away, right? Hey, it's Carl. I need an income statement updated on this property, Jake. Can you get it to me? Boom. 5 minutes later, he's got it. So it's being well organized. It's being prepared, and it's just being, I think, very straightforward and honest with them, and getting them what they need when they need it, and being professional, kind of knowing your numbers. I think that's key.
I think there's a couple of things everyone should do. They should have a Dropbox folder. Put your last 2 years of your tax returns in there. Have an updated personal financial statement. Have a good picture of yourself. I can't really get a good picture of myself, but I try to get the best one possible, right, Jake?
Dude, we got professional. Listen, man, we went the extra mile.
With the JCPenney's, bro.
Those headshots I sent you, those are professional JCPenney headshots right there, bro. $60. It was well worth it. So that one you got, yeah.
So, you're welcome.
Write a short bio of yourself. Tell a story about yourself. You're selling yourself. Right?
They like the story. That's right. Everyone wants to hear a good story, turnaround play. So have that prepared. What do you do to get the income up? Right?
And on top of us, we're fortunate. We have the Jake and Gino platform. We have a credibility book. We have a great website. We have a best-selling book. We have a great community. So all that stuff we can show them. We can show them social credibility. Whatever you can show them, bring it out to them and give it to them. And I'll tell you, the process is really laborious. I don't know why. I guess all government regulations, if anyone's going to tell you they're going to do it within 30 days, you have a better shot of seeing, I think, ice in hell than you do of closing one of these deals in 30 days. Even with us, I mean, there's two of us working on this thing at one time. We got them. I mean, within the first hour that they asked for, we would get them stuff. And actually, it was really complimentary because one of the girls in the office working there really sent us some really nice compliments throughout the whole process. Because I'm assuming that she works with people who aren't punctual and who put it on the back burner. But if you want to get these things done, you have to be very responsive. Listen, it took us over 60 days, and we had all of our stuff in line. So was it worth it? I would do it every day of the week, but it's a little stressful when you're going through it, but just be on top of your stuff.
Yeah, I love it. And that's kind of a good segue into the next question. I know you guys have built an incredible personal brand. You have a really popular podcast as well. What are some of the key takeaways that you have done that new entrepreneurs can learn from and can really expedite their process into growing their business and their role as entrepreneurs in the community?
Well, it's really funny. I just mentioned this to Jake this morning. We're doing the live event this weekend. We have about 175 people coming. It's over 200 people with speakers and all. And I would not have been able to do something like this unless I was financially free. I think everyone out there has to focus on becoming financially free with whatever you're doing. And then all of a sudden, everyone says work, do your passion, do what you love to do. No, become financially free. That will allow you to do what you love to do. Because I don't think Jake likes to walk into a smelly apartment and smell cigarettes and paint and all that. That's not what he loves to do, but that allows him to hang out with me on a podcast right now and to do a live event this weekend and to give back. So I think that's truly important.
And also stop being so damn cute with everything, because I'm going to tell you right now, we have a very successful podcast, and look, it's not produced very well. I'm not going to lie. We have good content on there. Sometimes the mic is too low. Sometimes it's this, sometimes that. We are by far like the probably worst tech guys you're ever going to meet. And we don't always know what we're doing. But the bottom line is, it's just like we said with the multifamily stuff. You got to get started. You got to get going, because if you sit there and get the analysis by paralysis, oh, this has got to be so perfect. I got to do this. I got to do that. You're never going to get started. You're never going to get anywhere. Jump in, get the damn thing done, see what happens, and just keep building off of it. Keep pivoting, keep figuring it out.
And I think, Hunter, the most important thing that an entrepreneur can do or think about is it's not about them. It's about what their customer needs or what the problem is out there. I think Jake and I saw that there was a problem in this market for, modern, clean, affordable housing in that space. We bought these properties. Tenants were complaining. They were crying that their stove wasn't fixed. They were waiting months to get a stove fixed. I mean, are you serious? It's not what Jake and I want. We want to get rich. We want money, but that's not going to solve a problem. What do you want? How can I offer value to you? And once you start offering value and start solving enough problems for enough things, the money will start showing up. And it's the same thing with the Jake and Gino platform. We've been doing it for a couple of years. We're out there, we're grinding it out there, we're figuring it out. We're not doing these beautiful Facebook ads and trying to sell product. We're trying to create value and see what the community wants. And from what they want, then we'll start adding and creating content towards that.
I love it. A great answer. Jake and Gino, I can't thank you enough. I'll make sure to link to that information. And why don't you give us a quick shout out as to where you want investors to contact you and how they can find more about you?
Yeah, so you can go to jakeandgino.com. At some point we're going to syndicate a deal, and we're collecting investor data now. So there's actually an Invest Now tab on there. So you can go to jakeandgino.com. You can go to randpartnersllc.com and check out some of our stuff there. And obviously the Wheelbarrow Profits podcast and the book, you can get it on Amazon. So check it out.
Awesome. Well, I will link to all those. Jake and Gino, thanks again. Can't thank you enough.
Thanks, Hunter.
Thanks, Hunter.
Great talk.
All right. Well, thanks again for taking the time to check out this episode. When I originally started formulating those questions, I assumed that they had taken on investor capital. So when they said that they had received the benefits of refinancing to the tune of several $1 million, that wasn't split up. That wasn't split up other than just the two of them. So pretty incredible. To give you an idea of how useful this tool can be, definitely something to keep on your radar. As always, we will leave our guests, Jake and Gino's, contact information in the show notes page. If you have any questions, you want to reach out to them, don't hesitate to do so. The great guys, always happy to educate and help fellow investors. Hope you guys have a great week. Thanks a lot.